Mortgage rates have finally dropped under 7%. It's the first time since August. Remember when went over 7% and people are saying, they're going to 9, they're going to 9%. Well, looks like they're going the other way. Finally. Let's get into it. Here we go.
You're listening to Seattle Real Estate Podcast.
Mortgage rates fell under 7% for the first time since mid-August this past week. It's the 7th straight week that rates have dropped. As inflation improves and the Federal Reserve paused its rate increases. So last week, the Federal Reserve got together and what'd they do? Nothing. They just held things tight, held things steady. But more importantly, the market perceived that to be, all right, we're not going to have any bumps in the near future. And in fact, what they took away from this most recent Fed meeting was that, hey, odds are we're going to have some rate cuts. So the market has been reacting very positively. The mortgage market has been reacting very positively to how the Fed is signaling its impact on the tools that can use for inflation and how it's using those tools. And it looks like we're finally getting a little bit of a respite from the interest rates up, they were up as high as almost 8%, right? With the Fed signaling in its most recent meeting last week, the rate cuts may be coming in 2024. Mortgage rates are expected to continue falling. Last week was, if you're in the mortgage industry, you're like, finally, we've got some good news because rates came down quite a bit. The 30-year fixed rate mortgage rate fell to an average of 6.95% in the week ending December 14th, down from 7.03 a week before. According to data from Freddie Mac released Thursday, a year ago, the average 30-year fixed rate was 6.31%. So not great, but with a 6 in front of it. And I only say not great from where we were 2.75%, 3%, something like that during the pandemic, because that is the measure that everybody is using. Well, I got a mortgage rate at 4%. I got a mortgage at 3.88%. All right. You can't get that now. So that means you're stuck. Whatever house, your condo, whatever it is you're in, you're stuck until you're willing to sell, take the proceeds, go buy another home, and enter into the mortgage environment whenever that might be. And up until, last week, it was well over 7%, well over 7%. The average mortgage rate is based on mortgage applications that Freddie Mac receives from thousands of lenders across the country. The survey includes only borrowers who put 20% down and have excellent credit. So these are the primo borrowers right here, right? None of that subprime stuff. None of that. A current buyer's rate may be different because if you don't have perfect credit and you're putting down less than 20%, interest rate's going to be higher, right? Greater risk. Potential home buyers received welcome news this week as mortgage rates dropped below 7% for the first time since August, said Sam Cater, Freddie Mac's chief economist, said in a statement. Given inflation continues to decelerate, meaning go down, and the Federal Reserve Board's current expectations that they will lower the federal funds target rate next year, we likely will see a gradual thawing of the housing market in the new year, Cater said. And I've been saying this is going to happen sooner than later, and here we are. Now, we could have a reversal. We could have a trend reversal. Something pops up in the economy, something happens internationally. All right, the markets pull back. They'll jump back and go, whoa, didn't see that one coming. Therefore, we're going to do this, and rates hike and rates spike. But I think what the consistent trend is and is going to be is that the numbers will come back on inflation that, hey, things are kind of getting under control here. And then you're going to see some lower interest rates. You're going to see the Fed talk about maybe making some cuts to their federal funds rates. And that's just the rate that they charge each other to borrow from the federal banking system, them as banks, not us as consumers. And then consumer rates will start to fall. Well, consumer rates right now are falling on the expectation of what we're talking about here in 2024, that rates are going to lower and they're going to be dropped. The average rate rose above 7% in mid-August and reached as high as 7.79% at the end of October. Recent weeks of declining rates indicate the highest mortgage rates of this cycle may have passed. Without some weird spike, I think they have passed. That's welcome news for would-be buyers who've been facing the least affordable market since the 1980s. Yes, the 1980s, relative to where pricing has been and what rates did, least affordable market. So that's one of the reasons, it's one of the clear and obvious reasons that this market, the market since call it July of 2022, has just been terrible. Because buyers got used to those low rates. And then sellers got used to having the ability, to sell my home, go out and buy in this market. I'm going to get a super low rate. Why wouldn't I sell and move on? Mortgage applications for the week ending December 8th increased from the week prior for the sixth consecutive week, according to the Mortgage Bankers Association. The increase was a strong indication that borrower demand is rising as a result of the recent decline in mortgage rates. Lower mortgage rates are especially welcoming for prospective first-time buyers who are still struggling to find available homes in their price range, he said in a statement. Supply in most markets is still critically low. And that's why we haven't had any major price reductions. We've had some prices kind of fall off just a little bit, but a lot of markets are still going up because what few buyers are out there are sucking up that little supply, and prices are still going up. They're still increasing in spite of the mortgage rates being where they are. So when these rates drop, and you've squirted a little bit of gasoline onto the fire with just slightly lower rates, I think you're going to see some big price increases. I think you just are. I don't think there's any way around it, especially in your more active markets. The markets that are further out, smaller populations, less buyer demand, I think those markets are going to have less impact. But your close core markets, close to your employment centers, I think they're going to have a spike in value because you're taking pressure of, oh my gosh, I got this rate right now. I don't know when I'm going to get it again. I've been waiting for 2 years to buy. Let's do it now. Don't care what the end price is because I want to get this rate. I think you're going to see some of that. And that creates that exuberance once again, where you're back with the multiple offer situation, escalation clauses, and all the paperwork. All right, you were the winner / possible loser that bought at the absolute peak of the market. Home buyers have been acting up opportunistically, jumping on rates when they dip and making offers during the period between Thanksgiving and New Year's, which is typically when the housing market slows to a crawl, said Lisa Sturdivant, Bright MLS's chief economist. But even as rates dip heading into the new year, the market won't heat up too fast due to stubbornly low inventory. No, it might not heat up, but I think your prices go through the roof. We often talk about how lower mortgage rates will bring more buyers into the market, Sturdivant said in a statement. But in this very unusual market where inventory has been locked down, it's more important to watch how falling rates influence prospective sellers' decisions. Are they okay with selling, taking those proceeds, buying that next house with that interest rate? Is that what's going on? Because only then do you have the sellers jumping into the marketplace, creating that supply that you just flat haven't had for the last year and a half at all. Here's the interesting fact. Here's what you need to know. Nearly 2/3 of current mortgage holders, 67% of mortgage holders, carry an interest rate of 4% or lower. 4%. Right? I mean, no wonder nobody's doing anything. They don't want to move off those mortgages. And more than 90% have rates 6% or lower. So when you are at 7-something%, close to 8%, people aren't doing anything. And that's literally what's been going on. The only buyers are buyers who have to do something. The only sellers are sellers who have to do something. Job transfer, moving closer to the kids, retiring, just got to that critical point, need to make that move. Those are the only transactions really going on, right? Because otherwise, why would you sell? Why would you move on? That means that even if rates come down to the mid 6% levels, motivating homeowners with ultra low mortgage rates to sell will still be difficult. It'll be a tough sell. Hey, you know that 4% mortgage? Why don't we replace it with the 6 1/8 mortgage? That'll just be genius, right? It's a tough sell because that doesn't make any sense. You're like, why would I do that? Exactly. Why would you do that? This reluctance will keep inventory low, said Jael Zhu, an economist at Realtor.com, in a statement, and buoy prices higher in the new year. That's what I think is going to happen. You're going to see a spike in prices because you've already got a constricted supply. Now you're going to add a little bit of fire. You're going to add some gasoline, putting out fire with gasoline. Little David Bowie there. You're going to be doing that to buyer demand. And, you get just a little bit of buyer demand on a market that has already shrunk so crazily with supply. What's that do? Multiple offers, boom, you're off to the races again. The disparity between today's higher mortgage market rates and the lower rates that existing homeowners benefit from on their current mortgages, commonly referred to as the lock-in effect, is expected to play a role in maintaining low inventory levels because they don't want to move off those. 4% versus 6.5% mortgage rate, where we probably sit now, 6.75%, something a hair under 7. 4% versus that, not going to move. 4% versus 5%, probably still not going to move. But at 5%, more likely to than 6.5 or 7 or 8. See where it's going. Those numbers aren't tricky to figure out. As home shoppers compete over the still limited inventory, prices are expected to stay elevated, maintaining affordability as a top concern. And that's why you haven't seen prices drop. Prices have stuck pretty tight. It's because there's such little supply. Investors anticipating the Fed would keep its benchmark federal funds rate, the rate that they lend to each other, at the current rate during its December meeting this week. That expectation pushed down mortgage rate in tandem with following 10-year treasury yields. Now, I said earlier that the federal funds, when those rates get dropped, it doesn't necessarily correlate directly. It doesn't impact mortgage rates directly, but what it does impact is the 10-year treasury yields. And that is what most mortgage rates identify with. That is the number. That's the metric that we need to be concerned with. So we've had falling 10-year treasury yields. While the Fed does not set the interest rates that borrowers pay on mortgages directly, its actions influence them. So what you're seeing right now is the influence of the Fed on the market in general, and it's trickling down to these numbers that we're talking about. Mortgage rates track the yield on the 10-year treasuries, which move based on anticipation about the Fed's actions. What's the Fed going to do in 2024? Super important. What the Fed's up doing and investors' reactions when treasury yields go up, so do mortgage rates. When they go down, mortgage rates tend to follow. And right now, the rest of this stuff is just more explanation of the same. Right now, mortgage rates are on a trend of going down. And I think you're going to see that into 2024. You're not going to have much supply. How low do they go? I think they go into the 5s. I think they go into the mid 5s. Now, the question is, will that be enough to get enough sellers and enough buyers into the marketplace to actually create a situation where we've got decent supply? I think whatever supply comes into the marketplace because sellers are enticed with the new interest rate environment gets absolutely eaten up, just gobbled up by the demand that's out there, because there's so much demand out there, and it's happening month after month after month because people aren't able to buy. They're saying, hey, this is too expensive for me. The prices didn't come down enough. It's too expensive. Interest rates are too high. I'm just going to sit this out. But they're sitting on the sidelines going, At what point in time do I jump in? Is it now? Is it now? Is it now? Is it now? I think they jump in when you get down underneath 6 and they start to go. They start to go. And with as little inventory is out there, and whatever inventory comes on is going to get sucked up by buyers that have been sitting back waiting. I think you've got another, little spurt of market activity where people are taking advantage of those relatively low mortgage interest rates, because the buyers aren't taking advantage of prices dropping because they haven't dropped. So it's a super interesting dynamic. And so much of this is influenced by all those trillions of dollars that we pumped into the economy during the pandemic. And then we were told, hey, don't worry, Sean, it's only transitory inflation. It's just going to be here for just a few months, couple of years later, and we were still here. But we knew dumping trillions of dollars into the economy to prop it up, that wasn't going to be just a month or two. It takes months and years for that type of impact to hit the market. And we started to feel that heavy in 2022. But a lot of that had to do with the Fed going up, nope, inflation's too high. Got to get it down to our target rate of 2%. Only way we can do that, we got to jack everything around that we can. And that's what they've been doing. But now they're at a point, the Federal Reserve is, where they're saying, you know what? Inflation looks like it's coming down. We're going to let things kind of just settle out here. We're going to let things settle out and see where it goes. And so when that happens, people in the mortgage industry side go, okay, all right, we're home free here for a little bit. They've committed to not bumping rates anymore. And if all they do is hold them steady, we're going to be in a better position. And that's when the rates start to come down. And that's why they've bumped underneath 7%. So hooray, rates have come down a little bit, but we're by no means out of the water, because nobody's refinancing and very few people are still jumping back in. But we're going in the more positive direction if you're in real estate. If you're in escrow, title, you're a real estate broker, you're a managing broker, you're a building inspector, you're a mortgage guy, whether refinance or purchase. These are the things that we're watching. All right, what impacts our livelihood? Well, we need some lower mortgage rates in here. So this is one of those steps. We're getting to that kind of level of activity where, things are okay and a lot more people can actually make a living in the industry, but we're not there by any means yet. Right direction, not there. Tune in, because I'll be talking about this some more. Thanks so much for being here. That's it for me in this one. I'll catch up with you in the next one. Bye for now.